All right, let's just dive right into this explainer because today we are investigating what might literally be one of the most fascinating deep value case studies on the market right now. We're looking at Stifel Financial Corp. It's a financial services holding company that presents us with a massive, massive puzzle. Because on one hand, you've got decades of proven wealth compounding, but on the other, well, there are some flashing warning signs that are definitely keeping Wall Street at arm's length. So our job today is to look at the raw data, piece this giant puzzle together, and figure out exactly what is going on with this stock.
And we're going to start with a truly staggering number, a 66.65% margin of safety hidden within the data. Now, if you know value investing, you know that finding a discount this deep is honestly like finding a needle in a haystack. It immediately begs the question, is the broader market missing something completely huge here, or are we just looking at a massive value trap?
To give you a sense of that mystery, let's look at the pricing. Stifel is currently trading at roughly $77 a share. But when you run the discounted cash flow models, they're suggesting an intrinsic fair value of over $233. Think about that for a second. That is a colossal gap. Pure cash flow math implies this stock is trading for just a fraction of its true worth. So let's move into Section 1, decades of historic returns and how playing the long game compares to these short-term dips. Obviously, anyone who bought in at the start of this year is probably feeling a bit of pain. They're facing a year-to-date dip of negative 6.4%. But watch what happens when you stretch out that time horizon. Long-term holders have seen absolute astronomical multi-bagger returns. We're talking over 788% in 10 years and an incredible 1,028% over 20 years. This is a company with a seriously documented history of navigating market cycles and creating massive value over the long haul. To really put that into perspective, that 10-year period alone translates to a phenomenal 24.94% average annual return. That, right there, is the absolute magic of compounding. Sustaining an annual growth rate of basically 25% for a full decade, that proves this financial engine knows exactly how to build wealth. It's a very rare tier of performance, and it demands our attention.
Which brings us to Section 2, dividends and cash flow. Basically, how they're rewarding the shareholders who stick around.
Now, I know a 1.75% starting yield doesn't exactly scream jackpot at first glance, but the real story here is the growth trajectory. They've got an incredible 27.65% 5-year compound annual growth rate on that dividend. They are aggressively hiking their payout, boasting a highly reliable streak of 9 consecutive yearly increases. And honestly, the best part, all of this is protected by a very safe payout ratio of roughly 29%. They are returning serious cash to shareholders while still keeping plenty of capital to fund their own growth. And what's backing up all those dividend hikes? An incredibly robust free cash flow yield of 8.76%. Since free cash flow strips away all that messy accounting noise, a yield approaching 9% proves they're generating plenty of tangible, cold hard cash. That severely limits the risk of those dividends ever getting cut anytime soon.
All right, moving into Section 3, analyzing the financial engine. Let's really look under the hood here.
The valuations present a very compelling case. Right now, the current PE ratio is sitting just under 20, which is, fairly standard. But then the forward-looking PE drops significantly down to 13.39. Guys, this is a massive tell. The market is pricing the stock today as if earnings are just going to stagnate. But that multiple compression, it strongly suggests analysts are actually forecasting a major earnings acceleration in the near future.
But okay, pause for a second. Before we get way too excited, we really need to talk about debt. As a quick refresher, the debt-to-equity ratio measures a company's leverage by dividing total liabilities by shareholder equity. It's a very direct measure of financial risk. And as we know, higher leverage can totally amplify returns in the good times, but it can be devastating when things go south.
And this brings us to the sobering reality of our investigation, and arguably the biggest reason this stock is heavily discounted right now. Stifel carries a highly elevated debt-to-equity ratio of 533. That means for every dollar of equity, they hold over $5 of debt. Now, sure, financial firms naturally operate with way higher leverage than, say, a software company. But a ratio of 533, that is a significant risk factor that we absolutely cannot ignore, especially when we're living in an environment of fluctuating interest rates.
Furthermore, if we dig into their margins, we uncover another huge piece of this puzzle. Stifel commands an incredibly high gross profit margin of nearly 99%.
Their core services are immensely profitable before operational costs. But after paying for salaries, admin expenses, the interest on that high debt we just talked about, and taxes, it compresses heavily down to just a 10.24% net profit margin. Actually, keeping the revenue they generate is a highly capital-intensive endeavor.
Okay, it's time for Section 4, the final verdict. Let's weigh all the evidence we've gathered.
To summarize the core tension over the last 5 years, decent top-line revenue growth of 10.7% has been slightly outpacing their bottom-line net income growth, which is sitting at 6.31%. Essentially, they are bringing more money in the door, but because of those compressing margins, they aren't translating all of that top-line growth to the bottom line as efficiently as they possibly could.
And if we look at just the trailing 12 months, well, that tension finally snaps. This right here is the smoking gun for why the stock is currently down for the year. While revenue did manage to grow slightly at 6.65%, net income actually contracted by nearly 7%. Basically, their costs grew faster than their sales over the last year. This directly explains the recent dip in the stock price and exactly why the market is so hesitant to award it that $233 fair value. The market is just sitting on its hands, waiting for net income to turn positive again. So as we wrap up this explainer, the ultimate question I have to leave you with is this. Does this staggering historical track record of 10-bagger returns and a massive 66% discount to fair value actually outweigh the current reality of high debt and short-term income contraction? Is the market correctly pricing in the risk, or are we looking at a generational opportunity to buy a wealth compounding machine at a completely steep discount? I really hope this breakdown has given you the clarity you need to keep exploring on your own. Thanks so much for diving into this with me today.